if you consider climate to be a hardware problem, there's definitely structural things there that make it very hard to back climate hardware. And I think that's why in Climate Tech 1.0, around half of the money was lost that investors put in at the start. I mean, if you look at hardware exits, I think it's around 11 years versus 7 years for software in climate. Yeah. And those exits are smaller as well, right? So why take the risk? A lot of that, I think, comes down to market timing. And I think that's something that is quite hard to look back on and learn from mistakes about what is right and what is wrong. I mean, I think we've learned the hard way with things like AR and VR on betting too early on a market that might not materialize or materialize in the way that we thought it would. And I think that's one of the benefits of not being a heavily verticalized fund, right? I think is that you can make those market timing risks, and that is what you are hedging against. If we're doing things in space tech where there's a huge amount of stacked market timing risk in terms of like cost of launch and cost of return, that is something that we are making, that a lot of our companies are making existential risk on.